fundamentally speaking, how are we stacked up? Let's talk about valuations and individual stocks which still offer value with Taher Badshah, Senior Vice President and Co-Head Equities with Motilal Oswal Asset Management, which is Motilal Oswal AMC. Taher, good morning and thank you for joining us. Taher, for the moment everyone is excited. There is a lot of momentum. But somewhere secretly, do you think markets have run slightly ahead of themselves and it's time to step aside and focus on fundamentals because the economy is still not showing signs of bottoming out?
Yeah, I would kind of agree with you. I mean, we've seen a fairly decent rally without any immediate indications of whether we will probably get a very good, earnings recovery. So to that extent, yes, the markets have a bit run up ahead of fundamentals. Although I would probably think that, we may not probably see very sharp corrections given that most of the macro cues seem to be positive for us, be it from the currency to oil prices to some of the other macro indicators which are showing an improving trend. So I would think markets are probably a little more likely to time correct rather than sharply correct in terms of price levels, just to ensure that it doesn't run up too ahead of fundamentals.
Taher, let's talk about banks. Now, most of the PSU banks from the recent lows are up by more than 40 to 50%. Do you think in the short term this is as good as it gets for banks? Because RBI is still sounding hawkish. Bond yields are at an 8-month high. God knows what will happen to NPAs.
So, in the context of the sharp rally in many of the stocks, quite a lot of the underpricing also of many of these names have actually, been absorbed by the market. So to that extent, clearly there is a time for a breather in these stocks. Although I'm not really significantly worried about bond yields at this stage, given that even though the short-term yields have spiked because of a few reasons as per the recent RBI credit policy. But I don't really think we are headed for high yields, or in fact, I think it is probably going to be the other way around, especially at least over a 6 to 12 month horizon, and as we keep seeing inflation soften. So, yes, near term, clearly, there seems to be now relatively less on the table, and we need to probably wait for the earnings season to come up, some of the results to be displayed, reassess, analyst earnings, street estimates on many of these names, both banking as well as non-banking, and then take it forward. So this sector again is a good case for a time correction.
Taher, the big disappointment really came in for the pack of financials which didn't bag a banking license, the likes of L&T Finance, Reliance Capital, Shriram Transport. Would it be fair the kind of pounding and thrashing these stocks would have got in yesterday's trading session? Because the management themselves seems to be indicating that all is not gone. When the new government comes in, there is some ray of hope that they may bag a banking license.
Possibly. I mean, I think in fact it should be looked the other way around, that maybe not having got a banking license for some of these probably might allow them to show a better financial performance, at least over the medium term, because clearly the banking business would have probably led to a certain amount of impact on their core business and the overall earnings and return ratios. So I would rather that some of these stocks which have moved up in anticipation of a banking license and maybe have got a banking license should probably correct, and those which have actually corrected on the back of not having got a banking license should probably be used to buy into, especially if you were to like any of the names out of those banks.
Would you be a buyer in Bajaj Finance or L&T Finance, or for that matter the Aditya Birla Nuvo, because the core business for these companies is still intact? Yesterday what we saw was a knee-jerk reaction, more like an event disappointment. It's not going to change the earning trajectory.
Precisely so. So, like I said, that any of these names, if they appear to be fundamentally appealing on their core business, then I think one should clearly look at it. Although we don't, at least in our mutual funds, we don't own any of the names that you mentioned, either a Bajaj Finance or L&T Finance. But clearly, I mean, if there are companies out of this pack which have shown a good amount of core earnings momentum over the last some time, and the general business environment continues to remain reasonably good for them, and if they are at, after this correction, if they are at some decent valuations, clearly they should be looked into. So I would think not getting a banking license at this stage probably might be a cause for celebration.
Taher, Asian Paints is an institutional favorite. Money managers, they simply love this company. At 538, what are your thoughts on Asian Paints? Price to perfection or some more headroom left?
See, I think in the FMCG space, quite a number of, the market is clearly trying to distinguish between stocks where we could probably still see a reasonably good earnings momentum anywhere between in the band of between 15 and 20%. And it's concentrating on those stocks. So, one is seeing a lot of dichotomy within that sector. So we see the likes of an Asian Paints, even an ITC for that matter, and yesterday even for that matter Colgate, wherein earnings are probably likely to be reasonably, good. Even though valuations seem to be on the slightly higher side, but if they are in for about an 18 to 20% kind of earnings growth possibility, then I think that's what is probably causing these stocks to, find some attraction, and probably it's also being used as an opportunity by many to actually invest in these names. So I think it's clearly where the market is likely to see pockets of growth. So again, Asian Paints, same thing, that if you've been able to increase prices, they're riding on that franchise. They have not seen a significant slippage in terms of volume growth as an industry per se. So I would think that's where the concentration would be, especially in FMCG, where you see a good combination of volume growth as well as possible modest increases in pricing as well.
Taher, what's the sense that you're getting about the auto pack? While the monthly sales numbers haven't been all that impressive and sluggish and mixed, if I may say so, but the index per se seems to be indicating a different pattern altogether.
I think some of these are clearly coming out of, a couple of things. One is clearly a month-on-month improvement, although March may not really be a very good indicator given the end of the year considerations. But many of these companies have seen a month-on-month improvement in the volumes. Some of them have benefited out of the excise cuts that we saw post the vote on account over the last 1.5 months, and this probably can build up further during the course of the next year. So market is trying to price that possibility. There is also, of course, the other thing about a possibility of a benign interest rate scenario going forward into FY15, and that's what that's the camp that we belong to as well. So I think from that perspective, and maybe if we can get a little bit of better economic momentum, clearly these stocks are have probably a little more room to go. They generally have very good balance sheets, most of them, and are not really very heavily leveraged. And have also probably benefited out of a benign raw material price scenario. You've not really seen a large increase in either steel prices or other base metal commodity prices. So that's again something which is going to be in their favor. So I think all in all, that is what is causing some of these names to show the strength that they've been displaying over the recent past.